Hi everyone, I wanted to provide an overview of Chapter 6, Problem Number 1. Actually, Problem Number 1 with multiple parts, and this involves Rubio, the taxpayer, and he has an investment in a partnership and there's a partnership loss, and the question is how much of the loss can he recognize on his tax return? So the starting premise of this problem is that we have to recognize that a loss is a benefit in a tax world, okay? Rubio has an investment. The investment, for whatever reason this year, did not generate any income. Instead, it generated a loss, and it's going to benefit Rubio on his tax return, okay? And why is that? That's because a loss is an above-the-line deduction on your 1040, okay? So what we're effectively talking about here when we talk about Rubio's loss is Rubio's deduction, okay? And when we talk about these three rules, the loss limitation rules, what we're talking about are deduction limitation rules, okay? Tax basis, at-risk, and passive income rules are the loss limitation rules. And what we're really trying to say is how much of Rubio's loss, how much of Rubio's deduction can be recognized on his tax return, okay? Now, let's walk through a couple, the facts here, and I'm going to focus on the facts that we need to really zero in on. We're told he has a tax basis in this limited partnership of $20,000, okay? That's the first fact. Second fact is that he has an at-risk amount of $15,000. We're going to talk about each of these facts in detail in a moment. Next, we're told his share of the limited partnership loss is $22,000. From another limited partnership is $5,000. Wage income of $40,000, and then a long-term capital gain of $10,000. We're not going to need either of these, but they kind of give context to additional facts that Rubio might have as a taxpayer. Okay. Let's look at each of these rules in isolation: tax basis, at-risk, and passive income. But first, let's look at what are we talking about with Rubio having a partnership interest. What Rubio did was he purchased a share into a partnership, meaning he became a partner, okay? He paid cash to become a partner in this partnership. His tax basis, okay, and we can think about this as like the amount in his capital account, okay? Think about it like the amount in his capital account is $20,000. It's his investment stake in the partnership, this $20,000, okay? Think about it like that. Now, that's his tax basis. What about this at-risk amount? Well, imagine that he came into this partnership and he only paid $15,000 cash to get entry into the partnership. And for whatever reason, and we have to imagine this, okay? For whatever reason, the partnership said, okay, you will get a 20,000% stake and you'll only have to pay $15,000 cash to do it. They know that he has a lot of cash on hand, so they want him to be a partner, and this was an enticement. So they're saying your tax basis, your investment in the partnership can be $20,000, and he only has to put in $15,000 cash. Well, Rubio's $15,000 cash that he contributed, it would be called his at-risk amount, meaning this is the actual amount of cash or property that he truly stands to lose if the partnership were to go out of business, okay? His tax basis is what we would say his investment in the partnership is. This is the value of the partnership that he has on paper. Oftentimes, these two numbers are the same, okay? They're different in this problem, in part to kind of illustrate these rules, okay? Just think of this as Rubio's true skin in the game, the $15,000. That's how much cash would be out of pocket if the partnership went south. Now, let's look at the loss. Okay, let's understand that, and then we'll go through the rules of the loss. So this partnership, let's say, has a $66,000 total all-in loss for the year. Let's say Rubio is a one-third partner. Because it's one-third, he gets one-third of the loss, so he gets a $22,000 loss. That's all that's saying. That's what this $22,000 is. So what the IRS is going to say is, they're going to say, okay, we want to test how much of this loss you can show on your tax return. Can he recognize the full $22,000 deduction as a full deduction, like all $22,000, such that he lowers his taxable income by $22,000, or not? Well, these rules are going to inform what he can do. Okay, the tax basis rule is the first rule, and it says, what's your tax basis? Because that's the limit, that's the ceiling that you can recognize the loss. That's what that rule says. Well, we know that his tax basis is $20,000. The loss is $22,000. he's going to be capped at $20,000 under this rule. He will only be able to show $20,000, and the glare on the screen, I realize, this is $20,000. He's going to be limited on his tax return to take, okay? The next rule, at risk, says, okay, what's your true at risk amount? Because that's going to also be looked at in terms of a loss limitation. And his at risk amount is even lower than the tax basis. It's $15,000. So this is even more of a constraint than the tax basis rule, his at risk amount. There's a third rule, passive income rule. And this looks at the idea of passive versus active income. So let's pause and talk about that for a second. So Rubio is in this partnership and he's standing off to the side, just kind of pumping cash into the partnership as needed. And the initial tranche of cash was $15,000. Okay? He's passively involved. He's not like the other partners who are actively going into the office, actively contacting customers, pounding the pavement, trying to drum up business. What he's doing is kind of sitting off to the side. He's got another job where he's earning wage income, and he's simply providing cash. He's passively involved. The IRS makes a distinction between passive and active income. Similarly, they make a distinction between passive and active loss. Okay? The rules are in your slide deck. They're also in your text as to what constitutes an active, if you're actively engaged in a trade or business. There's like, how many hours did you spend in the business? How many days were you actively engaged in the business? And so on and so forth. Those rules, you have to actually meet the threshold of those rules to be considered actively engaged. Otherwise, you're considered passively engaged. So Rubio is passively engaged in this partnership, and this rule basically says you can only recognize this passive loss to the extent that you have passive income. And we're told that he has passive income in the amount of $5,000. That's one of the other facts in the problem. So the passive income rule is going to limit Rubio to a $5,000 loss. And this is part C of your problem. How much can he actually deduct in his tax return? And the answer is $5,000. Because Rubio is limited by these three rules, and ultimately by the most constraining rule is the passive income rule, and it's $5,000. Now, a follow-on question is, well, what about the remaining $17,000 of loss? And the answer is he can carry that loss forward. There are rules around that, around how far into the future you can carry forward a loss. And this is where, losses is off, you'll hear the term if you're in a tax practice. It's an attribute. It's a tax attribute, part of his kind of profile as a client. Okay, so if you were a tax preparer helping Rubio, this is all information you need to kind of track. It has a multi-year kind of dimensional aspect to it. And this is where understanding and kind of how the interplay of kind of technology comes in. We want to be able to kind of track this tax data. Not only the tax computation, but follow it from year to year, okay? And it's why I'm emphasizing Excel and spreadsheet skills so much. Keep in touch with questions if you have them. Take your time with this, and good luck. And I'll see you in class on Wednesday. Thank you.